In 6 hours today, 1.28 trillion was erased from gold and silver. Silver is down 40% from its January peak. Every headline says crash. But in Shanghai, physical silver is trading at nearly $100 an ounce, 20% above the paper price on the exact same exchange, in the exact same city. So let me ask you something before we go any further. If the crash is real, why is the physical market screaming the opposite? What I'm about to walk you through is not a theory. Every number I reference is publicly available. CME open interest, CFTC reports, exchange data, official government budget projections. You can verify all of it before this video ends. What's happening right now in silver and gold is not a simple market correction. It is a simultaneous breakdown at every pressure point. Paper markets, physical markets, currency systems, debt trajectories, geopolitics, and industrial supply chains all cracking at the same time. The majority will see the 40% headline and conclude it's over. The minority who actually look at the data will see something completely different. This is for that minority. Let's get into it. In 6 hours today, the paper market did something that would have made headlines for weeks in any other era. Gold dropped nearly 3%, silver fell over 5%, 1.28 trillion erased, $280 billion of that from silver alone. And here's what the anchors won't tell you. This wasn't a collapse driven by industrial demand falling off, by mining supply flooding the market, or by any fundamental shift in the real economy. This was paper, derivatives, contracts settled in cash with no physical silver changing hands. The paper market retains full power to move price in compressed timeframes, regardless of what the physical market is doing underneath. That's the first thing you need to understand. The price you see on your screen is not the price of silver. It is the price of a paper promise about silver. Those are two completely different instruments, and right now they are diverging in a way that has no modern precedent. The clearest proof of that divergence is sitting in the Shanghai data, and you can pull it yourself through exchange reporting at no cost. Western spot silver is trading around $74. Shanghai physical silver is trading at nearly $100 per ounce. That is a 20% premium. But here's the part that makes this different from a simple east-west arbitrage story. That gap isn't just between continents. On the Shanghai Futures Exchange itself, physical silver is trading 20% above the paper futures contract on the same exchange in the same city, priced in the same currency. That is not a geographic premium. That is a shortage signal so loud the market can't paper over it on its own home turf. The $12 spread between Western and Eastern pricing that has been holding firm even as Western paper collapses is the physical market refusing to accept the derivative as a true representation of value. When that kind of gap holds and widens simultaneously during a paper sell-off, you are not watching a crash. You are watching a price discovery system breaking in real time. 8 trading days remain until first notice day on February 27th, when physical delivery begins against open positions. March silver open interest currently sits at 58,170 contracts. That represents 294 million ounces of paper silver. Now here's what makes experienced traders stop cold when they see this number. There has been no mass roll, no panic unwind. The clock is running down hard, and open interest is sitting completely unmoved against every historical pattern that shows mass rollover beginning well before this point in the cycle. Either the roll hasn't started yet, it's being deliberately delayed, or certain players are entirely comfortable holding this size this close to a physical delivery deadline. When open interest stays this elevated this late, it stops being a routine settlement question and starts becoming a genuine liquidity question for the exchange itself. Pull the CME open interest data directly. It's updated daily and posted publicly. The numbers are there for anyone willing to look. The options market is flashing something that initially looked like a data error and has now been confirmed as real pricing. Silver's 30-day implied volatility on CME options is currently more than 10 points higher than it was when silver was trading at $121. Its all-time high just 3 weeks ago. Read that one more time. The options market is pricing more explosive potential right now at $74 than it did at the peak. Convexity and skew spiked simultaneously, which means traders aren't just buying cheap calls on a bounce. They are positioning for something violent in either direction, with the weight of positioning tilting toward a sharp upside resolution. Implied volatility this far above where it sat at the all-time high, while price is 40% lower, is not a single anomaly. It's a coordinated market signal from participants who have access to delivery data, institutional flow, and information asymmetry. The fuse is visible in the options chain. Whether it gets lit is the question. 3 dates are now converging inside a single 7-day window with zero buffer between them. February 20th brings SLV options expiry. February 24th is silver futures American options expiry, and simultaneously, the day Shanghai reopens after Lunar New Year closure, bringing the Eastern physical premium back into direct contact with Western paper pricing and live trading. February 27th is first notice day, when physical delivery formally begins against 294 million ounces still open. Each of these dates carries its own pressure independently. Stacked into 3 days the way they currently are, they create a scenario where multiple triggers can interact in ways that are difficult to model and impossible to fully predict. The Shanghai reopening alone, dropping Eastern physical buyers directly into a Western paper-driven sell-down, could create immediate pricing conflict. When that happens simultaneously, with options expiry and delivery notice beginning, the word routine stops applying. Zoom out from the silver market entirely for a moment and look at what the currency data shows, because this is the context that makes everything else make sense. Every major global currency is simultaneously hitting new all-time lows priced in gold. Not just the dollar, the British pound, the euro, the yen, the Swiss franc, all of them breaking to new lows against gold at the same time. The U.S. national debt is now officially projected to surge $244 trillion per year over the next decade, reaching $64 trillion by 2036, with annual interest costs alone doubling to $2.1 trillion. That projection assumes zero recession across the entire decade. Nassim Taleb wrote in The Black Swan about systems that appear stable for long periods, accumulating hidden fragility beneath the surface, then breaking catastrophically when that fragility finally expresses. The debt trajectory is not a future concern. It is a present mathematical reality that is already expressing itself through currency debasement, visible in the gold chart right now. The metals aren't telling a metal story, they're telling a currency story. Industrial buyers are no longer waiting for the exchange to work this out. Mine CEOs are now reportedly fielding direct inquiries from major manufacturers who want to bypass the exchange entirely, with arrangements involving hundreds of thousands of ounces monthly at premiums reportedly reaching 20% or more above spot for guaranteed physical delivery. Samsung has reportedly already executed exactly this type of direct arrangement. This is not speculation about what might happen if the shortage worsens. This is the industrial response to a shortage that already exists. Silver is the most electrically conductive element on the periodic table. Every solar panel, every EV battery system, every AI data center, every piece of military electronics requires it with no viable substitute at scale. 1 physical ounce currently costs less than a pair of Nikes. When the manufacturers whose production lines literally depend on physical supply stop trusting the paper market to deliver, they don't wait for reform. They road around the system. And as that parallel physical market grows, it begins to set price based on actual scarcity. The paper price becomes increasingly irrelevant to real transactions. Iran fired missiles in the Strait of Hormuz today as part of a pre-planned naval drill, deliberately timed while U.S.-Iran nuclear talks are actively running in Geneva. 20% of global oil flows through that single choke point every day. Even a pre-planned demonstration sends a calculated signal when diplomatic negotiations are simultaneously in progress. Energy supply disruption flows directly into manufacturing costs, supply chain stress, and industrial silver demand that already carries 6 consecutive years of structural deficit underneath it. Separately, big tech credit default swaps have jumped nearly 400% in just 13 months, from $2.2 billion to $10 billion outstanding. A year ago, those contracts on major tech names essentially didn't exist. Now the AI debt binge that created leverage across the sector is being priced for default risk at scale. Bitcoin is falling, equities are under pressure, risk-off is hitting every asset class simultaneously. And in every historical period where simultaneous risk-off has hit, while physical shortages existed in hard assets, the initial paper liquidation flush was followed by a rotation into assets with zero counterparty risk. That rotation hasn't shown up in the paper price yet. The physical premium in Shanghai says it's already started. So here's where that leaves you. Paper silver down 40%. Shanghai physical up 20% above its own exchange's paper contract. Open interest completely unmoved with 8 days to delivery. Options market pricing more explosive potential at the lows than the all-time high. 3 critical dates stacking in a 7-day window. Industrial buyers routing around the exchange at 20% premiums. Every major currency hitting new all-time lows against gold. $64 trillion in official debt projections. And now geopolitical pressure on 20% of global oil supply. These are not separate stories. They are one story about a system hitting simultaneous stress at every pressure point at the same time. I am not telling you what to do with your money. What I am telling you is this. Do not let a 40% paper drawdown be the only data point you look at. Pull the CME open interest. Verify the Shanghai premium through exchange data. Read the official budget projections from the primary source. Look at gold performance across multiple currencies simultaneously. The question I'll leave you with is the same one the data leaves me with. If paper silver gets sold down 40%, while Shanghai physical simultaneously trades 20% above its own exchange's paper contract, which one of those prices has an expiration date on it? Invest with logic, not hype.